Welcome back to Homebuyer University. Today we're talking all about HELOCs. What are they? What are the pros and cons? And are they right for you?
A HELOC is basically an acronym for Home Equity Line of Credit. And what this is traditionally a second loan or a second mortgage on your property. And there are two essential forms of a HELOC, one when you're purchasing a property and one when you already own your property. We'll start off with the more common of the two, which is one when you already own your property. So say you own a home and you have a bunch of equity in your home and you want to tap into that equity. You don't want to do a cash out refinance. You don't want to change your first mortgage, but you do want access to the equity that you've built in your property by paying your mortgage down or by market appreciation. A home equity line of credit, or a HELOC, is a fantastic tool to dive into that equity and turn it into cash you can actually use. Effectively, what you'd be doing is applying for that second mortgage, that HELOC, and it would be put in place. And it kind of works like a credit card against your house. Say you have $100,000 worth of equity in your house and you want to access $50,000 of that. You would take out a home equity line of credit or a HELOC for $50,000. And it just kind of sits there like a credit card. You don't have to use it, you don't have to spend it, you actually don't make payments on it if you're not using any piece of it. However, maybe you do want to use some of it. Maybe there's a bathroom remodel that you have in mind. Maybe you take $10,000 of that $50,000 HELOC that you just had and you use that to improve your bathroom. You're not making a payment on the full $50,000. You're only making a payment on the $10,000 that you're actually using of that line of credit. This is why a HELOC is a great way to get access to that equity in your home for a pretty low cost and a pretty low repayment for what you're actually using. This is why a HELOC has been a favorite for many homeowners throughout time, anytime they've been trying to do any upgrades or renovations to their property, or if they just want to have an emergency fund that they can access down the road in case something comes up, or if they want to have some sort of access to equity in their home in the event another home comes up that they want to buy, and most of their wealth is tied up in the equity of their home.
The other type of HELOC is what we would call a piggyback HELOC. It's a fancy way of saying that it's a second mortgage that's used in conjunction with your first mortgage to help you qualify for your home.
So that piggyback or purchase HELOC isn't quite as common as that standalone HELOC. It's really more of a tool to help get you to a certain price or to a certain mortgage amount that you might not have otherwise been able to get to. It's also a great tool to potentially even avoid mortgage insurance. Essentially, it helps give you extra purchasing power while maybe not necessarily being as hard to qualify for, and maybe be a little bit more lenient on repayment terms and total monthly payment for a period of time. Effectively, it's a great way to avoid jumbo loans, it's a great way to avoid mortgage insurance, and it's also potentially a great way to achieve a higher price point if you're short on your own funds.
Dom, both of those sound really good. What are some of the cons that you might see when getting a HELOC?
HELOCs all have the same con. It is effectively an interest-only mortgage. So for a 30-year term, your first 10 years are interest only. So whatever you're paying is pretty low because it's all interest. However, after that introductory 10-year period is up, you start paying back principal and interest, which means those payments can potentially go up pretty dramatically because it's also an adjustable rate mortgage. That rate isn't fixed or locked in, it fluctuates with the market. So the big con is there's a little bit of anonymity to what you'll be running into as far as your payments go. What we recommend is always having an escape clause. Andrew, could you tell us kind of what those escape clauses might look like?
We recommend having a plan to pay off or significantly pay down that HELOC within the first 10 years before the principal payment starts. There are 3 ways to do that. The first is continue paying on your HELOC, but pay a little bit extra so you're taking care of some of that principal. The other way is to simply sell your house. And when you sell your house, you're paying off your first mortgage and your HELOC. And the third way is to do a refinance where you wrap everything into one mortgage, paying off the HELOC, leaving you with your first mortgage.
So HELOCs have a lot of pros and cons. They offer a lot of flexibility, not just for home renovations and repayment plans, but potentially the purchase price and terms of your loan when buying your property. But you do want to be conscious of their repayment terms, especially after that 10-year mark hits. So they could be the right tool for you. Just make sure you're looking at it not from a short-term perspective, but also from that long-term perspective, and make sure you have a plan in place, not just to use it to get into a house or to get into a project, but to get out of it before those payments might get uglier than you want it to be.